All right, let's get to that last method, that double declining method. And let me give you your notes on that one. All right, double declining balance method. There are different types of declining balance methods. There's 1.5, 1.75. We're doing the double because it's just easier to calculate, right? And it's fairly common. So this is an accelerated form of depreciation. Accelerated form of depreciation. So a company might use this method. It helps decrease their income tax. Right? When it says accelerated depreciation, that means we're going to record more depreciation expense. If you have higher expenses, you have a lower net income. Lower net income means less taxes. Okay, so that might be a reason a company would select this method. Okay, so it's going to result in higher depreciation in the assets first years, and lower depreciation in its later years. And some managers feel like that's a better match, right? They think, okay, in the earlier years, year 1 and 2, I want high depreciation expense, right? Because if you think about it, I'm probably not spending much on repairs. But then in the later years, I might be spending more on repairs. This is my repair cost, and I want to spend less on depreciation. So it kind of all evens out, right? Depreciation is higher than repairs, and then it's low when your repair costs are high. So in total, you're going to spend the same amount. It's just the mix of depreciation and repair costs will be different. All right, let's look at the formula. There are 3 steps to calculating depreciation expense under the double declining method. The first is to calculate your straight line rate of depreciation. The second is to calculate your double declining balance rate of depreciation, and then use that to calculate your depreciation expense. All right. So let me give you the formulas. So to calculate your straight line rate of depreciation, you take 100%, divide it by the useful life in years. Life in years. That gives you your straight line rate. Okay, the 100% does not change. Calculate your double declining rate by taking the straight line rate from step 1 and doubling it. That gives you your double declining balance rate. Use that rate to then calculate your depreciation expense. Your formula for that is to take your beginning book value and multiply it by that double declining balance rate from step 2. That gives you your depreciation expense. This one, as you can tell by the increased number of steps, is the most difficult of the 3 to calculate. And it's difficult not just because of the extra work, but there is just an added layer of complexity with this starting point, with starting with the beginning book value instead of the depreciable base. Okay, the best way to illustrate it, we shall work through an example with Anne's Flower Company. So grab your handout and we'll work through that in the next video.